Next up, our panel discussion with Jason Fichtner, Vice President and Chief Economist at the Bipartisan Policy Center. He'll be joined by Farouki Majeed, the Chief Investment Officer of the School Employees Retirement System of Ohio, and they will once again be joined in discussion by the Hill's contributing editor, Steve Clemons. Jason, Farouki, Steve, thank you.
Great, thank you very much, Jason. Okay, folks, if you weren't looking, it's 9.1% is the number, and this is not our conversation, but I just have to say it because we're in the news business. But I was on a call yesterday with Brian Deese, who's the President's National Economic Advisor, and he did not know the number, clearly, because he was saying why it was likely to come down. Gas prices were coming down, price of oil, a lot of the structural core components that were going into the index that they watch were coming down, and they thought of it. So it's 9.1%. So I just need to sort of start with the news, to both of you. Are you surprised, and is this a red alert? Jason?
I mean, I'm always surprised because I always thought it was going to go down, but realize we are still.
They did too.
Well, realize we're in a COVID
That's why they did a call with us.
And we still have a lot of supply chain issues that we still have to come out of. But the one thing you didn't realize or get to when you're thinking about inflation is what that means for the Social Security cost of living increase.
Right.
That'll happen, which will most likely be the largest increase in 40 years when they announce it
right.
in the fall.
Farouki, as you look at your investment horizon, does this frighten you at all?
It doesn't frighten me. It sort of challenges me in different ways. I've said for quite some time that we are in very unfamiliar territory as far as investors go, right? We've had 3-4 decades of an economic regime where we had inflation trending down. So that was a secular trend. Interest rates trended down. And macroeconomic volatility was way down. So that regime is now changed. So we have passed, I think, the inflection point. We will see higher interest rates, higher inflation than the 2% that the Fed would like to see. And so that creates a different kind of investment environment. And the conventional portfolio would have some challenges dealing with this new kind of environment. Thinking of rather the 60-40 equity fixed income portfolio.
Right. So Farouki, let me ask you, because today we are talking a little bit about retirement broadly, and we're going to get to the broad picture. We're also looking at the variety of investment tracks that someone like you have a huge fund in the School Employees Retirement System of Ohio, and apparently you had a really good year last year, and people kind of were celebrating. You had a 26.7% return. We all want to know the secret to that. We have a lot of people online saying, "Hey, we want to sign up for your Twitter feed." But as you kind of look out there and you look at how do you distinguish long-term returns, and I've been sort of I've been kicking the tires of the private equity issues and how it builds. So how do you see that dimension of class of investment with regards to what you're doing as you steward the retirement savings of teachers in Ohio?
Yeah. So our expectation, or the actuarial interest rate assumption, is now 7%.
7?
Yeah.
Okay.
So that's over the years, that's come down from 8 to 7.5 to 7 in different kind of steps. So that is, there is an expectation that the going forward returns would be lower than what we've been able to generate in the past. As you reduce your expected rate of return, the actuarial interest rate assumption, your liabilities go up in the computation, and therefore the challenge of meeting your long-term funding goals become more of a challenge. But our fund, the funded ratio currently is 74%. It was as low as 62, 64, something like that at the end of the financial crisis. So we've made some, very steady progress here over the last 12, 14 years. So over the next 10 years, I don't think we will have, we can gain the same sort of increase in our funded situation, because I think our expected returns are going to be much lower than what we've been able to generate in the past 10 years, which is about 10.5%. The other issue that many mature pension funds have is the cash flow situation, which is that they pay out more in benefits than they get in contributions, because the retiree role keeps growing. The active employee role is not growing that much. So the ratio of retirees to actives keeps increasing.
Right.
So that's another challenge that mature pension plans have. So we're dealing with those types of multiple issues. But one of the things we've done is try to be as nimble and tactical as possible within the limits that our board has given us in order to try to steer the fund through these rather choppy periods. So for the year ending June 30, 2022, our preliminary returns are just a tad below zero. But our policy return is something like -5% odd. And I know some of my peers are reporting returns as bad as -7, 8 sort of percent. So we've been able to be somewhat nimble there, to have very low exposure to fixed income. Last year we were
So
at the
you're
bottom.
basically telling us something very important, that we can't get addicted to these giant returns you got in the last fiscal, that there are real challenges out there
Yes.
in the economy. And I would just jump to you, Jason, and ask, I always find economics, slightly close to alchemy, right? So trying to understand, what are the dependable parts of it? And in my book, the dependable parts are tracking over time, looking at performance. And I'd just love to know in your map, what's the scaffolding we should care about? When you look at the private equity world, they're investing nearly $1 trillion last year. Drew was up here, did this kind of cute thing the other day in Union Station, walking through, kind of identifying all the companies that had private equity behind them. We heard Pam talking about private equity and a lot of small business. So there are a lot of dimensions there. What would you say are the blind spots in that discussion? What do we need to understand about capital and equity and investment in this economy that we're not getting right?
I think one of the things, this is where Farouki brought it up as well, and you mentioned it, we need to start thinking about cash flow. So when do you need to have cash coming in? And this goes back to Senator Toomey also with the defined contribution plan.
Right.
This is not just about DB world, it's a DC world too. We are shifting from a DB economy, a DB retirement system, to one that is primarily DC. But
that's been a many-decade process.
But it's still ongoing. And the thing is that what the DB world was so good for was giving people a paycheck for life, right? That's what you're trying to give them. You're promising a benefit.
Right.
But they were underfunded. You had some plans that failed. Private DB plans were going the wayside. You still have some state, local, and teacher left. But now we're going to a DC world because there's access to the market. But people are losing now this paycheck for life they like. So now we got to think about, how do you have your DC plan have asset allocation that includes
what they have,
private equity, that also includes something like maybe a partial annuity or annuity to help complement Social Security. So the blind spots go, one, education, which Senator Toomey meant. And the second, remember when we were all growing up, and one of the first lessons we learned about investing was diversification. So think about all this as asset allocation. What money do you need to have in fixed income? What do you want to have in equities? What do you want to have international? What do you want to have in private equity or hedge funds? But you think about this as a long-term allocation. Some things you're going to want to have, like dividend-paying stocks, are doing very well right now. They're paying out record amount of dividends. How do you allocate those and start thinking about this from a cash flow perspective? And this changes over time. So history is not necessarily the best indicator of the future, but we look at it. But the question now is, how do you figure out your portfolio mix, your allocation mix? And we started thinking about, I've been looking at this more in the target date fund world. We've made it really easy for people to default into a target date fund. Now, not all target date funds are the same, but we're allowed to have that.
Just for our viewers' sake, can you explain what that means?
So a target date fund is basically, imagine you have a defined contribution plan, you go through Vanguard or Fidelity, they all have these funds, and they say, what year do you think you're going to retire? 2050, 2055, 2060. They then have a mutual fund that is an investment portfolio of a variety of different equities, internationals,
designed
bonds,
to get to that date.
It's designed, but it reallocates every year. So this goes into the allocation. If you're young, you're 25, you're not retiring for another 40 years, you have time to invest in assets that are less liquid, for example, say private equity or stocks, that over the long run perform better on average. So you have a chance to grow those up. But as you get closer to retirement, need more fixed income or dividend-paying stocks, the allocation will change automatically towards those. Now thinking about someone who needs some sort of fixed income protection or annuity, you could have some contracts in a target date fund that buy annuity contracts to give some of that paycheck for life, that DB type component.
Right.
But to get that allocation, to get that high asset amount for retirement, you've got to have a great allocation going up that has good returns, which means you've got to have some private equity, some equity as well. And this is where I think that the education is missing, is that people want to say, you can't invest in this, you can't invest in this. The question is, you can, but at what percentage? What is the right allocation amount, given the risk portfolio you have, the age, and when you start needing to have cash, whether you're a DB plan or a defined contribution plan investor? That's what we're missing, is this conversation about how do you grow assets over the long term, what's the proper allocation you need, and then when you get to the point where you need cash flow, how do you make sure you have that cash flow coming in?
Farouki, let me ask you another dimension about your investment decisions, and you do it. I have spent a lot of time looking at the private equity world and things like renewable energy or other kind of ESG-like activities that are out there. How much does that come? I mean, how much do those factors come into your calculations in a real way? And I'm just asking, bottom line, does ESG stuff matter to you or not? Is it just simply raw financial performance that matters? As you look at the performance of, we know from the report that's just come out from the American Investment Council that those pension funds that have brought in private equity have done remarkably well. Growth rates 15. The performance has been 15% or higher in many cases that I was looking at. But that side of it, what are you looking at? Because a lot of us in Washington, I think, are easily distracted by the shiny penny of whatever newfangled thing is out there. But what's on your radar screen? Just give it to us as it is, as real.
So we are very much focused on the returns. So that's how we look at opportunities, right? So as you mentioned, our private equity return as of the end of June 2021 was 17.6% over 10 years. As of December, it's 19.2 over 10 years.
Right.
And the 10-year total fund return is 10.5. So we were able to get to 10.5 primarily due to very solid private equity returns of 19.2% over that period.
So what was the worst performing part of the portfolio?
Yeah, over the 10-year period, the lowest returning asset class obviously was fixed income.
Which may not be the case going forward. So what I think what he's also getting into, and this is the idea, is the private equity return was fantastic, but you don't have 100% of your assets
in private equity. No, you don't. So we have 10%. We are now increased to 12% because our board would like to see more of that kind of return to improve our return. So that is our primary focus. And fortunately for me, as the CIO, our board is very much focused on that as well in terms of their fiduciary responsibilities. They do care somewhat about things like ESG and so on. We tell them what we are doing. We are very strong on the G side of E, S, and G, which is the governance part of it, in terms of how we vote our proxies, how we get engaged with companies in terms of shareholder proxies and votes and issues like that. So on that part, we are very active. In terms of the E and S, we don't have any board-directed mandates in terms of, say, for example, divesting from fossil fuels. I know many...
You don't have that. Is that unusual you don't? Because I don't know what the standard is in the industry.
It's not unusual. But many state funds, particularly the larger state funds, like CalPERS and so on.
CalPERS does have some of that.
Yeah, they do because, these interest groups that are interested in those kind of policy matters tend to focus on, those types of funds. So nonetheless, we do think there are opportunities. Even though I don't have a mandate to put X amount of dollars into environmental or alternative energy and so on, but we are seeing opportunities, and where we see opportunities, if we can get the kind of return expectations that we have, then we are happy to invest in it. So we have invested in what are called climate mitigation type strategies.
Right.
So these are some private equity type investments that are focused on improving energy efficiency, particularly in certain types of high energy intensive industries, like steel and aluminum and so on and so forth. So those are designed to improve energy efficiency in terms of the usage. So and then we do have some in alternatives, perhaps solar and so on and so forth. So those are the kind of opportunities that we are interested in.
I think about what Farouki's doing, what he has to be. He has a portfolio and he has beneficiaries. He's got retirees that are current and his retirees that are coming in. He has an actuarial concept. Here's what I've got to pay out the next couple of years. So in some ways, he has to have a portfolio that has some liquidity to pay out current benefits and benefits that might come next year. Then he's got to grow the assets also coming in to make sure he's got enough cash to pay 10, 15, 20 years out. So when we start thinking about this portfolio allocation, when I start hearing people talking in the policy circles that, well, you shouldn't invest in private equity or it's too risky, you don't want to do this, you need to have a risk-adjusted portfolio that includes things that have long-term average higher returns. That's the only way you're going to have the cash to pay out benefits 10, 20 years from now.
Do you dream about risk-adjusted retirement
portfolios?
That's
all we do. So the one thing that, that recently fell into I've been appointed to the Puerto Rico Pension Trust.
Let me ask you,
so
what's your first name, my friend at Tax Notes? Ben Guggenheim of Tax Notes. Ask a question. It's just been twirling in my head. And he really said, look, with all this stuff that we've been doing in retirement broadly, half of Americans don't ever retire. Is it half of Americans don't ever retire? And so, it reminds me when I worked in the 1990s in the Senate on health policy, and we were looking at, we had at that point 13 major health reforms, and you couldn't show that you had covered any more Americans with health insurance. And eventually, the Affordable Care Act, it did make a dent in that. But we had to kind of look at the fact that everything that we were trying to do with health insurance was failing. And I'm interested in the retirement side because I was involved in helping to write legislation, and I think it was called the Pension Pro Save Act or something. And it was at that time a way to try to put together a system, particularly for service workers and labor workers that were that rather than having them put the first dollar in savings first to potentially be matched by the dollar, it gave employers the option of putting that first dollar first and putting dollars there. And we were looking at ways in which we could get some element of habit and of savings behind more Americans, and thought that would be there. Now, I don't know the situation today. I know what it was 20 years ago, 25 years ago. But I'm interested in his question in whether or not we're playing with the world of those that have, and they're getting more options. But what do we do with those that don't?
Well, so don't forget, when we talk about retirement, we think holistically, right? And so that includes your own personal savings. That includes either a DB plan or an employer-sponsored defined contribution plan. And there was that third pillar, right? We always talk about the three-legged stool. What's the third leg? Social Security. So we need to make sure we have good Social Security policies, so Social Security is solvent. We don't want to get to a point, we're looking at trust funds being depleted around 2034, 2035 right now, where if Congress does nothing, and so far they don't seem to be on track for doing Social Security reform anytime soon, we could see a reduction in benefits of 20-25%, which hurts those who rely on Social Security, or a tax increase that could be 33% increase in your payroll taxes, or some sort of allocation of government revenues that go to the fund. Maybe we do some sort of private equity to try to make up revenues and for future gains. But Social Security has to remain solvent because a lot of people still rely on Social Security. But we now need to think about this as an economic system, a holistic retirement system. Because for some people, they're going to get Social Security and have a small defined contribution.
Well, you're at the Bipartisan Policy Center. Can't you just fix this? Both sides?
We're trying. We've been doing good. And give Congress credit. Secure Act was very good. Secure Act 2.0 will now allow it that goes through for some automatic enrollment for people, so employer plans. The states have stepped up, where there now have state plans to let people who don't have access to an employer plan do it through the state. So we're starting to actually move the needle. And a lot of this has been done in the last several years. So, but for those people who are starting small, they might get to retirement with a small DC plan and Social Security. So then you think about how can you leverage Social Security? Social Security is the greatest, best inflation-protected annuity you can buy. For every year you delay claiming, it's an 8% return you get on your monthly payments. Maybe we can use that small DC wealth they have to allow them to delay claiming Social Security, 1 year, 2 years, 3 years, up to 7 to 70. Now we need to talk holistically. How do you how do you grow that defined contribution assets to something that gives them a stream of income to allow them to have something?
We're right near the end, and I do want to take a question maybe from Mark Bloomfield, my friend out here in a second. Just picking on you, Mark. But one last question is, we think about the private equity side of what we've seen as the performance of the release of the American Investment Council's report. I'm just interested, if there were to be a greater diversification of investment choices made by DC plans or others out in the investment community, the level of overall private equity investments, as I understand, is around $1 trillion a year and growing right now. Does that, and I hate to, I don't want to upset them in a way, but does that dilute, or what does that do to performance? Does that change the fact that they've had extraordinary performance over the last 10 years? Does opening up those options increase, decrease, or not affect at all the factor of private equity in American investment?
Hard to tell right now, but you would think that it could possibly lead to some dilution of returns.
And why would that be?
In the sense that when you have more and more dollars pouring into this, and then the investment opportunities, right? So you're going to have to go look for investment opportunities. There's going to be competition amongst the various asset managers. And so what happens in cases like that is sometimes the multiples on asset purchases can go up. Means they're paying up more money to buy a company than they otherwise would have done. So when you pay up upfront more money, then your potential returns down the road are sort of clipped by that extent. So there could be, I don't know for certain, but our strategy in private equity, we are not a very large fund, right? Like in the several hundreds of billions of dollars that others have. And so they have to put out tens of billions of dollars in private equity. Our private equity portfolio is about $2 billion. So we are focused on what we call the middle market and small market buyout kind of opportunities.
Right.
We think that those will still be somewhat protected from, new inflows that might potentially come through the opening up of private equity to, individual investors and so on and so forth. So it depends on, what kind of.
Right.
I don't think every private equity asset manager is going to opt to do this. The larger ones, I think, would do, like the KKRs and the Carlyles and Apollos and things like that, possibly. And many of them are publicly listed companies as well. So,
just a quick second, yeah.
There's a flip side of this, right? The more money that comes in is chasing investment return. You get to what's called regression of the mean, right? So the way to chase dollars means you're getting more closer to the average of the market. That also means you potentially would reduce risk, so that your variance on the tail side would also narrow as well. So you might get the best of both worlds, maybe a little bit higher return, a little bit less risk for it in the long run. And I think what Farouki is getting at, which I think is important when thinking about how we educate and talk to consumers about this and the public and beneficiaries, is it's not just how did you do last year, it's how has this performed over a 10-year basis.
Right.
Then you show the ups and downs and how it averages out and how in the long term you're better off having this diversified portfolio.
Right.
That includes private equity. Again, think about asset allocation, how you grow this for the long term so you can have the cash to pay benefits when you need it.
Fascinating. Mark, I genuinely, do you have a question? Because, Mark's president of the American Council on Capital Formation, so he's an expert in this. But do you have a quick question, Mark?
Yeah, just
right in the microphone.
Number one, you ought to be more like Steve Clemons and me, which is the individual responsibility. That is to save. Unlike Steve, I drank too much and all that other stuff. The second thing, what's fascinating is, did IRAs start in 1978?
Mark, hold the mic a little closer.
Did IRAs start in 1978? I think they did. Yeah, they did. And what I commend you all is the tremendous progress we've made since 1978. I mean, I'm here because I'm old. I want to secure my retirement. And thanks to what everybody's done, Steve, we've got 401ks, IRAs, 457Bs. So I think it's two things. It's the unfortunate human condition. We may not save enough, but what Congress and other people are doing is moving us towards a consumption tax, which is my dream. Thank you.
Well, great. Well, we will end there. I'll come back to you. Have another quick question for our gentleman up here? No. Like, bringing the mic. No, you have the answer no. Well, I will leave it there then. I want to thank Jason Fichtner, he's Vice President, Chief Economist, Chief Alchemist at the Bipartisan Policy Center. I don't mean that, I mean Chief Economist, of course. And Farouki Majeed is Chief Investment Officer for the School Employees Retirement System of Ohio. It's a pleasure for you to take us down this journey, and it's great to get a sense of the dashboard you think about when it comes to investment. What are the dependable pieces of it, and where we're going, because I think retirement anxiety is a real issue in people's lives. It's also turning into a political issue, and I think it's very important to discuss this. So thank you both very much for joining us.
That brings us to the end of our program this morning. On behalf of The Hill and our sponsors at the American Investment Council, we'd like to thank everyone who joined us here today and all of you who tuned in online. The full event video will be published shortly on thehill.com. Thank you very much, and enjoy the rest of your day.